Good morning, everyone. My name is Michael Naidrich, and I am the co-CEO of F Securities. Today, I am joined by my partner. We have our repeat guest today, and very excited as I think we have a great slide presentation. We have the Chief U.S. Interest Rate Strategist from Bloomberg, Ira Jersey. Ira, welcome back, sir.
Thanks very much. I appreciate you having me back.
Coming up, as always, a lot going on. I'm excited to see the slide presentation. So, Greg, I'm going to hand it over to you and Ira and step out of the way here, sir.
All right, sounds good. Thank you, Michael. Ira, it's great to have you. As you know, I know in March I had the privilege of joining your podcast, your fixed income macro podcast, and I'm grateful for that. So I know you've got some tremendous slides for us today. We're going to cover a lot of ground in and around the Fed. So for sake of time, what I'd like to do here is pass it off to you, my friend.
Yeah, thanks very much, Michael and Greg. I really appreciate you having me back. I'm just going to briefly review where we think the Fed is, because that's going to matter not only for the Treasury market, but also for broader risk assets in general. So we can't have any discussion of the Fed has to start with the economic environment and where we are. So the way that we see the economy right now is that we did have somewhat of a slowdown in the second half of last year and very early this year, but we've rebounded from there. So very similar to a mid-cycle slowdown, not dissimilar to what happened, say, in the mid-90s or in 2015, when you had some sectors of the economy that were having significant difficulty, but in aggregate, the economy wound up kind of holding on and having a decent run. If that's true, and we are in the midst of a recovery from that mid-cycle slowdown, instead of slowing down significantly faster, then that probably means that the Federal Reserve's going to be on hold for some time, and that's particularly true because of what's going on with inflation. Obviously, and we all know that the Federal Reserve has two mandates. One is full employment. The other one is stable prices, which they continue to define as being 2% on the headline and core PC deflator. So we use CPI just as a proxy for that. The PCE tends to be around 45 to 50 basis points below CPI. So if CPI, but CPI continues to run at 3.5%, and we do get that data on Wednesday morning prior to the Fed meeting, and one would think, and even if that comes out as expected, you'd still be running at around 3.5% for headline CPI on a year-on-year basis, and that suggests that PCE is still 3-ish% as opposed to falling back toward that 2% target that the Fed has. Importantly, a lot of the lower volatility sectors is what's driving this higher inflation, and those tend not to shift their price trends very quickly, and so those tend to be service sectors. So if you look at what's gone on in services, almost all inflation that we've had over the past almost year now has come from the services sector. Big part of that is certainly housing, but even non-housing services sector still is seeing inflation upwards of 4 or 5% in some sectors. And then you look at some of the forward-looking indicators like the ISM surveys, and while ISM manufacturing continues to be pretty tame and suggests maybe a contraction, you've recently had a rebound in the services ISM survey, suggesting that you still have very decent demand for services from the household sector and also from business services as well. So if service demand continues to be relatively high, there's not a strong and compelling reason to think that services inflation is going to decline very dramatically, especially given that services inflation is so highly dependent on what's going on in the labor market. And we had the jobs report last week, and even though the household survey was a little weak and the establishment survey was positive, the more important aspect from that report that I take away is that you still had wages growing at over 4% year on year. That is going to be passed along by a lot of businesses, and a lot of those businesses, like I said, 70% of employment is in the services sector. So if wages are growing at that pace, we'd continue to think that services inflation will remain very sticky. The other thing from the Treasury market perspective that's been going on, which I think is important to at least acknowledge is that when you look at 2023, the market was following a lot of these surveys. So whether it was the ISM survey or the Michigan Consumer Confidence Survey and the like, that shifted pretty dramatically starting earlier this year, where there were economic surprises and survey data were negative. So the survey data was surprising negatively, but the hard data, right? So the non-survey data was beating expectations and actually increasing, and the Treasury market has been following more the hard data than the survey data. I think one of the reasons why there's this disconnect between the hard data and the survey data is it has a lot to do, quite frankly, with how we receive our information and with the fact that it's an election year and things are very contentious, that people don't feel as confident as their actual spending. So when you look at consumer spending, for example, that actually continues to grow at a reasonably decent pace, again, 4-ish% year on year, as opposed to going down. So people aren't spending their lack of confidence; they're actually overspending their current confidence level. And I think that's just showing that people feel differently than what their actual actions are doing. And keep in mind, this is all on a real basis too, that I'm talking about this spending. So what does that mean for the Fed? Well, firstly, I do think that for the Fed, it means that they're going to be on hold. There's not a big compelling reason for them to move at any time before the election at this point. You look at we have different natural language processing models. So these large language model, we can call it AI, whatever you want to call it. But we have sentiment models that tend to do a pretty good job in determining whether or not the Federal Reserve is hawkish or dovish. And right now, it's exactly zero, or very, very close to zero. And because so that suggests that the Fed even isn't really close to making any kind of move, whether it's hiking or easing. I tend to focus on what Jay Powell says, just because he's the chair and he gives a better sense of what the entire committee is thinking, as opposed to listening to any one or two members who happen to be in the press all the time. And Jay Powell has mentioned that they're not thinking about hiking, even though you've had a few members that said, we'll hike if inflation reaccelerates, which I suspect that they would. But inflation's not reaccelerating, inflation's just going sideways. And because inflation's going sideways and they think that policy is restrictive right now, then that means that on hold has to be your base case until something changes significantly, and in particular the inflation data, but also other hard data that you might look at, like if we start to have job losses, for example, that would certainly increase the chances that the Fed's going to cut interest rates. But in order for them to hike, I think at this point you would have to see a reacceleration of inflation and have CPI going back up toward 4% on a year-on-year basis for them to think about hiking. The market also thinks that the Fed's going to be on hold, so we use the options market on some short-term interest rate futures, and you can see from the purple line in the chart that I'm showing right now, there was a significant probability of interest rate cuts. In fact, the median expectation from the options market was that the Federal Reserve was going to cut interest rates 5 or 6 times by the end of this year. Over the last 5 months, that's shifted quite dramatically, where now the market is pricing for only one interest rate cut this year, maybe slightly more than that, but basically one interest rate cut this year. And I think that's a reasonable expectation and outcome, and it's probably pretty fair just given the preponderance of data that we've been receiving over the last couple of months. There's not a lot of reason to think that the Fed's going to be able to move more than that. And I actually think that there's the growing possibility that the Fed actually won't be cutting interest rates at all until sometime in 2025. I mentioned before that the elections and political partisanship that's been increasing. If we look at the latest data from an organization called VoteView, it's some academics that actually look at congressional votes, every single partisan congressional vote from the very first Congress back in the 1790s all the way through this past April. And what you can see is we are now the most partisan that we've ever been in both the House and the Senate. This includes the third Congress when they were debating the Alien and Sedition Act. That was up until this recent period, the most contentious that Congress had ever been. And this this just suggests that we're going to continue to have this like lack of confidence in the political system. It's going to get really contentious come August, September, when we really get into election mode, and we wind up having not only the presidential election, but what's going to happen with the House and the Senate in terms of which parties are going to be in charge there. But generally, when you look at the Treasury market usually just completely shrugs off elections. The one exception to that was the 2016 election when Donald Trump was elected, and the market was a little bit surprised by that. You did get a reasonable change in trend at the during that period of time, but normally you don't get a lot of market volatility within the first week or two of an election, and then after 90 days you wind up getting some significant moves, but I don't think that those can be attributed directly to the election. So if you're thinking about the election as a vol event, I think that it's probably not going to be, because the market's going to be discounting for the possibility probably of either party or both parties, and what that potential outcome might be. Now, importantly for the election, there is something that we do have to pay attention to, and that's who are going to be in the leadership positions in the Federal Reserve, because the next president will actually not have so many members of the Board of Governors to appoint, although there is one, because Adriana Kruger, her term does expire in 2026, but the Fed leadership will certainly be changing over. So that includes not only the chair, but also the vice chairs of supervision and the vice chair for monetary policy. All of those people will be reappointed by the next president. So we'll be listening pretty closely to who is whispered to be the potential nominees. And quite frankly, if Donald Trump is elected again, I can't say reelected, it would be elected a second time, right? When it would be only the second president, by the way, that would ever happen. If he is, I was surprised that he appointed Jerome Powell in the first place, because Jerome Powell is kind of a centrist monetary policy thinker. I figured that President Trump was going to appoint someone who was much more dovish. He didn't do that. But I think this time he'll probably pick someone maybe who is mainstream, but more dovish than Jerome Powell or some of the other like mainline Republican or Republican appointed members of the Board of Governors or one of the presidents. So it wouldn't surprise me at all if we did get a somewhat more dovish person in there, although I suspect that whoever that is will wind up all of a sudden becoming pretty centrist anyway. So what does this mean for the Treasury market and for how to position? So if you're not a levered investor, if you're not a hedge fund or a dealer desk who's taking a position, what's happened over the past year and a half is you've seen obviously this large sell-off in treasuries, where treasury yields now are 4.5% and above, depending on where on the curve you're looking at. And what it means is when you think about the market from a risk reward perspective, you can see that when we were talking about 2021 and go back 2 years or 3 years, what you can see is back then there was almost no margin for error. So if you went out and you bought a 5-year treasury, and the treasury market sold off 4 basis points, which by the way is like just your normal daily move, you would start to lose money just because yields were so low. There was no yield cushion. Today, over that same 3-month horizon, the 5-year treasury would have to sell off 26 basis points in order for you to start losing money. So what this means is that now there's some juice in the front end of the yield curve, where from a risk reward perspective, you can make 4.75% by buying, or if I'm looking at the Bloomberg terminal right now, 4.87% buying a 2-year note, and you'd have to have 2-year notes sell off in a 3-month period about 75 basis points for you to start to lose money by buying a 2-year note, and they'd have to sell off 500 basis points. So you'd have to get yields up to 10% for you to start losing money by buying a 2-year note over the next year. And the chances of that is near zero, right? So, I'm never going to say never, right? But there's some, minuscule tail event that could maybe push 2-year treasuries up to 10%. But the probability of that happening is as close to is limiting on zero. So again, I think the front end has some interesting risk reward characteristics. characteristics that the back end just doesn't, because you could see significant volatility in the back end of the yield curve. You do give up some potential upside in terms of price, because if 10-year yields rally, if the whole curve just moves, say, 100 basis points lower in terms of yield, then 10-year treasuries, 30-year treasuries will significantly outperform 2-year. But on the other side, if the market does sell off even 50 basis points from here and say goes back to 5%, you start losing money in the 10-year, whereas the 2-year you'd still make money. So with that, I think I did okay on time here, Michael and Greg. So if either of you have any questions, I'm more than happy to answer them.
Greg, I yield to you, sir.
No, that was great, Ira. Super comprehensive, great charts, great buckets. As always, I appreciate all the work that you do at Bloomberg, Will, as well. I think your research is second to none, and we love the platform. Mike, I'm going to kick it back to you to see if you might have like a quick question for Ira and myself, or where we are time-wise here.
Yeah, one quick one. I know we're up against a little bit of time, Ira and Will. I was just reading as you guys were presenting this great, work here, that JP Morgan and Citi saying, dependent on the inflation data on Wednesday and what the Fed decides, might be a jolt to the overall markets. Do you have a thought on that?
Yeah, that's not impossible. I think you'd have to get a very like a 1/10 miss or beat on CPI wouldn't necessarily, I think, make any the Fed shift significantly from what its current thinking is. My base case for this week is that the Fed's going to basically give us a little bit of detail as to what they're thinking, what their new base case is for the economic outlook, and then obviously for the rate outlook. And I don't think that that's going to change enough for the federal for the market, at least the rate market, to move very much. Now, I think for risk assets, the idea that one of the reasons why risk asset valuations maybe have been so high, where credit spreads are as tight as they are and equities is high, might be in part because the market continues to price for interest rate cuts. Now, if the Fed comes out and says, okay, we're only going to cut one time this year, and we're only going to cut 2 times next year in 2025 because we think we're very optimistic about the economy, then you could probably get somewhat of a repricing in some of those risk assets, I would imagine. Now, I'm not the expert in that, but for the Treasury market, I think that you'd wind up getting maybe a little bit of a rally, people buying 10 years in a flight to quality bid, but I suspect that you'd still wind up in the ranges that we've seen over the last couple of months, where you're talking about 4.3% to say 4.6 or 4.7% on the 10-year. Greg doesn't like that because he does more trading when the market's volatile. But I think we end up being very volatile in that relatively tight range for now, until the real data shifts significantly, and I doubt that that's going to happen with this one CPI print.
Thank you for that. I think we're going to have to cut it off here, although I probably have 7 or 8 more questions. But the data here was excellent, and we always appreciate you, Ira and Will. It's a pleasure to have you with us. Greg, you know how much I enjoy doing this. So look, Fed remains front and center. There's a lot going on here. Some of our European counterparts have already cut, so we'll see where we end up here on Wednesday. It'll be very interesting, and as always, I know Greg, you'll be diving into the notes afterwards, giving our clients, the visibility moving forward. So, Greg, thank you as always. Ira, thank you. Will, thank you. And to all our clients, if you have any questions, please reach out to your representative, and we'll be sure to get Greg on the phone with you. Thank you so much, everyone.